we can summarize everything we need to know about inventory pretty easily. We've got a ledger to inventory and we've got inventory cards. So first thing we need to know with that ledger is what are the transactions that go in and will there be debits and credits? So inventory is an asset, and the rules of debits and credits say for assets, the side that goes up is the debit side and the side that goes down is the credit side. So what we're going to do for the rest of the year is go through what transactions will go on the debit side, what will make it go up and what will make it go down. So I think the easiest way is to remember one side and then it's kind of opposite on the other. So for example, we could say, what's going to make inventory go up? Well, the biggest thing will be when we purchase it. So we'll have cash purchases will go there, credit purchases will go there. And what's the opposite of a business purchasing inventory? Well, it's selling it. So cash sales of inventory will go there and credit sales will go there. Obviously, it will be the cost price. We call that the cost of sale. What else will make inventory go up? There will be a thing called sales returns. That's when customers bring things back to us. So that makes inventory go up. And the opposite of that, what makes it go down, is a purchase return, when the business returns that inventory to the supplier. And the last thing that makes inventory go up is what we call an inventory gain. We gain inventory, which we'll deal with in a separate topic later. The opposite of that is when we have an inventory loss. So they're kind of opposites of each other. So that makes it a little bit easier to remember. You've only got to remember sort of 4 things and then just the opposite. Then we've also got a few downs that we'll need to remember sort of one by one. So other things that will make inventory go down are drawings by the owner, inventory used for advertising, and what's called an inventory write-down, which are all things we'll go through at one point or another during the year. And that's everything. That's everything that would make inventory go up on the debit side and everything that would make it go down. So that'd be a really good cue card to make, to just have in front of you at all times. Now, that's the ledger. What's the relationship between the ledger and the inventory cards? Well, all of these transactions, so we've got the ups on this side, we've got the downs on this side, so debits on the left, credits on the right, they'll need to go in here at some point. And the easiest way to remember it is, well, when inventory goes up, that means it's increasing. So what makes inventory, that's an in. So the ins are here. These are ins and these are outs. So the debits on the inventory ledger will go in the in column. We'll put them there. So the in column should have cash purchases of inventory, credit purchases of inventory, sales returns, and inventory gain. And then the out side, that will be the credits here, and they will all go in the out column. So we want to look in the out column for the sales of inventory, both cash and credit, purchase returns, inventory loss, drawings of inventory, inventory used for advertising, and inventory write-down. So, and that's the link between the two things. We've got the ledger. Ledger, it's a debit, is the increase side, so that's the in side. So the debit side matches the ins, and the credit side, that makes inventory go down, so that's going to be in the out column there.